for our first corporate issuer of Canada Rocks today, we have the newest publicly listed company, which is Lithium Royalty Corp. Ernie Ortiz, the CEO, last week just went public, raising some $150 million Canadian. It's listed on the Toronto main board, ticker symbol LIRC. That's Lithium Royalty Corp. Ernie, you and I guess, go back, I think, to maybe 2015, 2016. You used to be at a fund Tide Point. This was like early Lithium 2.0, where you were largely investing in larger cap companies. Like Albemarle was the proxy for high lithium prices then, and SQM. I remember SQM was like $30, and then it was $40, and then it was $50, and then it was $60. But right, but still, there was some skepticism among major hedge funds about investing in a developing company. But you since left that. But for our investing audience that may be unfamiliar with investing in royalty companies, right? I see you as a diversified play if you don't want to just invest in a single, particular company. But you're very different than, let's say, an ETF that might be available as an investment opportunity for diverse exposure. You've just been through, 50, 60, 70 meetings with institutional investors. You cut back some people, and fortunately, you got it done before a bunch of bankruptcies in America, which is now knocking your stock below the issue price. But introduce yourself, help us think through the investment case, for Royalty Corp, in lithium, and then Rodney will ask a series of questions after that.
Sure. Thanks, Howard. Thanks, Rodney. Just to introduce myself, Ernie Ortiz, President and CEO of Lithium Royalty Corp. Since inception, since we started it over 5 years ago. But to your question on benefits of a royalty business model, and you touched on one of them, diversification. Two other ones that I want to underscore for your viewers are high margin with free cash flow, and lastly, optionality. So first, on diversification, there's 29 royalties in the LRC portfolio. So no single asset makes or breaks us, very well diversified. So you can gain exposure to a variety of projects and have the benefits of scale and diversification, which lowers the overall risk profile. And then second, the high margin with free cash flow. So LRC is focused on top line revenue royalties. And through this structure, there's no exposure to either OPEX or CAPEX. And as you guys have seen, there's been dramatic inflation in both OPEX and CAPEX throughout the sector. So this is a great way to enhance the free cash flow generation of an investment while also having the thematic of lithium at your back. And then lastly, optionality. In the majority of cases, once we've done an investment, there's no additional outlay or cash outflow from LRC to the operator or developer. So to the extent that they enhance the asset, whether it's production expansions or adding mine life or adding resource, that's all free carry to LRC and to the benefit of LRC, the LRC investor.
Okay, great. So as lithium prices rise, you get all the benefit, but as lithium costs rise, you don't have any impact.
Correct. Yeah. So our royalties are on revenue. So we'll just collect a proportion of the revenue that each project generates.
So Ernie, the lithium industry is changing. It's becoming more complex. There's geopolitical issues that are surfacing. Do you have any sort of strict criteria or preferences around jurisdictions and countries as to what you can invest in? I mean, do you have any hard no's? How does it work?
Sure. So there's no strict restrictions or policies at this time, but our key driving force is to invest in high grade and low cost assets that ultimately will get into production. And Howard alluded to some of them already, but we have a royalty on Core Lithium, on Sigma, and on Sediment Mining, which all are guiding to production in 2023. And to the benefit of lithium, it's a special asset class across the mining and EV metal space in that the majority of the production or feedstock today comes from well-established mining jurisdictions, and Australia comes to mind. So going forward, and even historically, our preference has been for Australia, Canada, Brazil, and certain parts of Argentina. And while there's no strict restrictions in place, we will shy away from countries or regions where property rights, royalty registration, where it's not favorable, and where we think that permitting is going to be an issue. Those are all factors that we weigh considerably.
Okay, sure. And in terms of composition and flow sheet and so on, do you have any preferences with hard rock versus brine versus DLE versus sediment? I mean, how do you kind of factor that in your choices?
Yeah, good question. So historically, we've had a bias towards spodumene or hard rock resources. That's largely been a function of the smaller capex profile and shorter timeline to production. When we first started off, we wanted to maximize near-term cash flow for LRC, so that really drove our bias towards hard rock. So we do have the majority of our assets today are hard rock. That said, we do have exposure to Argentina and to brine with two great assets, one in Catamarca and one in Salta. And we are evaluating DLE at the time. We'll continue to evaluate it. We do evaluate all sorts of various projects in the lithium sector. But overall, they need to pass a very high bar in order to enter the LRC portfolio. The key driving forces, as I said, are high grade, low cost, long asset life, being able to have visibility towards permitting, et cetera. So we'll look at everything, but it's a high bar to get into the LRC portfolio.
Just a quick question. I'm sorry to interrupt there, because I remember, we were involved with Lithium Americas for a while, and there was a royalty that Orion, put on there, and I think someone else, that was for sale, and someone else bought it. I think a London royalty company. Were you involved in that process, and why don't you have sediment royalties?
Oh, so we actually do have a few sedimentary royalties in the United States and one in Serbia. So we do think that clay and sedimentary has an important role in the sector going forward. That said, not all clays are created equal. So I think there is going to be differentiation across that, and especially tied to how much sulfuric acid is used on an LCE basis for these types of assets. And correct, there is a royalty on Thacker Pass, which a competitor in London has, and there is some public record on that I can refer you and your viewers to.
And Ernie, just with the IRA having been released recently, has that changed your view a bit on North America, a greater focus?
Yeah, great question. So it hasn't really changed it dramatically. Even before the IRA, since 2021, we've grown our presence in both Canada and the USA. Key assets that we added were the Winsome assets, which you guys know very well as well. CanSet, Adina, and Cermak. We have 4% royalties on those assets. We also had an asset on Moblan from Sayona Mining. So several assets that we added before the IRA introduction. We always had the view that it was very attractive geology, and that over time there would be a localization of the battery supply chain. But that said, the Inflation Reduction Act has definitely supercharged the attention and the investment into North America, which no doubt our assets will benefit from. And then more specifically, it hasn't changed our view dramatically, but I would say that it has enhanced our confidence that North America will be a key member of the electric vehicle revolution, whereas before China and Europe were the key leaders. It does seem like North America is catching up in a very big way.
When it goes through the process at LRC, how do you evaluate, looking at the opportunity? Do you stress test pricing assumptions? I mean, I know you said low cost and long life, but are there sort of more nuances in the evaluation process?
Yeah, no, there definitely is. So the key things that we stress test are timeline, volume, and price. So we're very conservative across all those three metrics. But then there's also a lot of assumptions that go into all those three criterias. We do our own in-house technical due diligence. We also have external validations and technical reports that we evaluate. There's a lot of historical mining reports as well that we go through. We also look at that overall flow sheet. We have had a preference towards DMS processing, which is simpler and can be cheaper in many of the cases. And we also do a lot of correlations when it comes to grain size and just the size of the crystal. So there's definitely a lot of work that's involved in evaluating these assets.
Okay, so Ernie, you're a royalty company. There's a number of gold royalty companies. I don't know, Silver Wheaton and Royal Gold and Franco Nevada. So gold investors may be familiar with this. There is some scarcity value for if you are a royalty investor and you know royalties and are interested in royalties, there aren't really many ways to play that. But if you're interested, you're not a royalty, like how do you value a company like yours, right? It's one thing if you're a single company, you know, they're going to get into production, they're going to generate a certain amount of cash flow. Here you have 25 plus assets. How should we think about the valuation and growth?
Yeah, good question. And you're right, the royalty business model has been well proven. It's a proven concept in the precious metal space and also in the base metal space. So what we've seen historically across the royalty business model is that they're valued on a price to net asset value basis. So it's a P to NAV for short. And typically analysts use discount rates anywhere from 5 to 7%, but it depends on the overall operating company and royalty company that and the asset base that they have. And historically, these precious metal royalty companies have traded anywhere from 1.5 to 3 times P to NAV. And then based on the public information and sell side estimates from today, gold producers or the actual operators of the assets trade anywhere from 0.5 to 1 times P to NAV on average, whereas precious metal royalty companies are trading at 2 times P to NAV or higher. So there has been a historical premium for royalty companies, and it's partially because of the reasons we outlined in this presentation that there's no OpEx exposure, there's no CapEx exposure with the royalty business model. It's a more diversified and lower risk to play the sector, and it's very free cash flow generative. A lot of these royalty companies have EBITDA margins in excess of 70% or more, and that's throughout the cycle. So it's a lot less volatility, a lot more free cash flow, and it's been and all of these precious metal royalty companies have generally outperformed on a share price basis relative to the operating class.
So as a company, I mean, it's you and a few other kind of analysts, your financial guys. You don't need hundreds of people building mines, and so your margins are really better than software margins in the royalty business model overall, correct? Right? You're getting all the revenue generating assets, and no exposure to cost other than your salaries, you know, office space and the like, right? Is that fair?
Yeah, no, I think that's a fair point. I think we have around 10 or so employees today. CFO just joined us from CIBC. COO and good advisory panel as well with Matt Juno and Cameron Henry. Yeah, this business model is definitely more scalable.
Okay, and it should be correlated to lithium price, right? As a proxy for, you know, if you think lithium prices are going up, you know, you're going to get higher royalties on the higher revenues from that. So, okay, you just went public.
Well,
so
and then just on the point there, just it will be correlated to price, but one thing that we are evaluating and looking more closely at is that the volume correlation will also be very important. And Sigma is a good example that since we acquired the asset, they've gone from a publicly reported 220,000 tons of production to over 700,000 tons of production once full phase 3 is outlined and fully ramped up. So of course we will have exposure to price, but the volume optionality will also be important as these assets gain scale and expand production.
So you just went public. You're kind of still in a quiet period or a cooling off period among your syndicate. The syndicate was led by Canaccord and Citi, and I think TD Cowen and Cormark were also in there. I would expect some of the analysts covering them, once they're off the restricted list, you know, will start publishing detailed research so you could see the underlying assets that you have. Okay, great. Ernie, this was a great introduction. To be continued.